Hello, everyone. This is Jerry Mee with the Boston Institute of Finance, joined by my friend and colleague Mike Long, and today we are going to be going over the Secure Act. Now, the CFP board has put out this great document detailing the key elements of the Secure Act and what it means for test takers, so we wanted to go through this with our students and cover all the high points that you need to know in order to get the best possible score on your exam.
Yep, exactly. So let's see what they had to say and just highlight some things for the folks.
Yeah, let's dive right in. So up first, we got maximum age for IRA contributions repealed. This is, I feel, one of the biggest changes of the Secure Act, so I'm not surprised the CFP board put it at number one.
Yeah, it just expands that window to if this was one's sole way to save on a tax preferred basis for retirement, it's nice that they can push that out. And there are more and more folks who are working beyond age 70. And so to be able to continue to save on a tax preferred basis or perhaps even tax deductible basis, that could be huge for some folks.
Yeah, and what's important to remember, though, is just because there's no longer an age cap on when you can contribute to IRAs does not mean they also got rid of RMDs. RMDs are still a thing, and it's still something you're going to have to work with clients about.
Good point. And we would want to analyze that. What is the benefit? Let's say that I'm 71 years old, have no intention of retiring. So I have compensation income, which would qualify for IRA contribution. I think we'd need to look at that and say, is there a benefit for this being deductible versus maybe I should put this into a Roth? And then look at what's going on at work too, because if the person's going to continue to work and they have access to a 401k, we need to look at that. Would they be better off saving those same monies through the 401k, where technically they could defer RMDs until they actually retire from that job? Mm-hmm. So there's a lot of moving pieces in this that we want to analyze first. And some would say, well, why? In a couple of years, you're going to hit the RMD anyway. You're really only gaining, a couple of years of that, but there still could be significant tax benefit depending on the size of the person's IRA from which they would need to take RMDs. And there still could be some tax savings by dropping $6,000 or $7,000 into the IRA, even though they continue to have earned income and RMD. Just, you have to do the math on it.
Yeah, I feel you'll probably see a question like that where you're going to have a situation or case study where a client's kind of right on the border, because the higher your tax bracket, the more sense it makes to continue to make deductible contributions.
Exactly. That's an excellent point.
The trick is not going over the amount where you can no longer deduct those contributions. So I feel what's a tricky question you could run into is someone who's right on that border where they're making, just enough to be just under the phase outs for the deduction, but still in a high enough tax bracket that making that contributions is still pretty powerful tax move for them.
Exactly. Yep. And we're talking marginal brackets here. Right now we're in a pretty low bracket environment.
That's a good point as far as being in a low tax bracket environment, because there's no guarantee that we'll stay in this environment. In fact, sooner or later, we will change from that environment. And when tax brackets go up, making that contribution, even after 70 or 72 now, it'll make more and more sense the higher the tax brackets get. Another thing that I really zoom in on these slides, Mike, are the learning objectives in this bottom right-hand corner. I feel those are the little pieces of free points that the CFP board tosses out. I feel those learning objectives are really hinting at what the types of questions they'll ask.
Yeah, and that kind of led our comments here, and imagine the scenarios that are attached to those learning objectives. What might be going on, what might be the client's goal. And I agree with you. Those are three good approaches to testing this particular point.
Yeah, definitely. So understand the impact of continuing contributions beyond the age 70 and a half. evaluate the impact of choosing a Roth IRA versus a deductible IRA, depending on legacy and charitable goals, and recommend the action that best meets those goals. And then finally, analyze whether pre-tax versus after-tax savings late in a client's life is a good idea from the standpoint of tax diversification and estate considerations. All of those kind of just play into what we were talking about, is it going to be a good idea to put that money back into the IRA? Or would you be better off, deploying that money somewhere else that's a bit more efficient? And
What role does it play and how long will it sit there?
yep, and no easy answer for that. It really is a case by case basis, depending on the client and their, unique situation.
Yeah, and for the exam, you want to pick out the objective. I like to read the last question or the last sentence of the question first to try to insulate from some of the noise in the fact pattern and the narrative, but pick up on what's their objective. And that's where these variables come in about charitable goals or legacy goals, what their income needs are. Those are all what the board calls contextual variables. And we need to be adept at picking them out of the question stem.
True. Correct me if I'm wrong, though, Mike. I believe RMDs are now starting at age 72. That's another change with the Secure Act.
It is. It may even be the next slide.
Okay. I was just a little, because they're still referring to 70 and a half on this, but maybe that's just because in the document they hadn't got there. They didn't want to tip their hand with any spoilers about the exciting Secure Act changes, Mike.
Yeah. I think it's the very next slide.
Perfect. Well, yeah, let's dive into it.
Let's see.
No, this is the annuities. We're saving the best for last time.
I don't get the points.
But this is another big one. I feel what could be one of the biggest pitfalls, both for the test and also just real life. The fact that 401ks can hold annuities now. And I actually really like what the CFP board has done with this slide. They cleared up a lot of information and really try to highlight those pitfalls so that advisors don't fall into them, because there is definitely some considerations that need to be made with this, pretty massive change.
I agree. It'll be interesting to see how this plays out, both in how it's communicated and utilized, and frankly, just how many people would be interested in doing something like this. So that path would need to lead to where they just absolutely want to have guaranteed income that can never run out. But the interesting point will be, well, what rates can they get in the annuity, and what expenses are associated with it, and what other investments could provide that same income stream without kissing goodbye a lump sum. That makes me a little nervous.
Yeah, that's definitely something we highlighted when we did the podcast episode about the Secure Act, that lots of questions with putting annuities in 401ks and a lot of downside if you're not careful with it. And what I really zoom in on this slide is the second bullet point under considerations. Planners need to consider holistic and fiduciary due diligence to evaluate a client's needs in regards to a quote unquote one size fits all annuity prescription. Man,
Yeah.
one size fits all annuity is definitely not something I think of when I think of doing what's best for the client fiduciary standard. It really conjures up some negative I don't want to say just negative experiences with annuities, why annuities got a bad name in the early 90s when everyone was just kind of shoving clients into annuities, regardless if they were actually good for the client or not.
Yeah. I mean, there's a huge education element to this, which kind of puts pressure on the fiduciaries of the qualified plan. And because the participants are going to really need to know the ins and outs of one or more annuities that they could select, it's confusing. And we'll just see. I hope they do a great job of setting up the education. I mean, annuities can be great for that one specific need or objective, but it can be wrong for a lot of other things. So we just have to be careful and make sure that it absolutely is the best option to attain that guaranteed income element.
Yeah, I definitely give props to the CFP board for drawing attention to that. I mean, my takeaway is the CFP board is basically saying, hey, Just because annuity companies made it easy for your clients to have annuities in their 401ks does not mean your job is easy in your recommendations. You still need to do your due diligence. You still need to do your fiduciary duty. And because these annuities are this like one size fits all tied to the 401k plan, you're probably not going to have as many options as you would a private annuity. You really need to be on the ball to make sure that the annuity being offered actually fits your client's goals.
Yeah, exactly. I like the fact that the law requires portability. That if one has started, they say the annuity is suitable for me. It is plays an important role. Great, and for that reason, I'm glad they can take it somewhere else without paying surrender charges or having to liquidate it out to reinvest.
Mhm.
So that part of the law I think is good, but just beware. I think we all just have to beware and learn more about this and just spend more time on goal considerations and deeper planning.
Yeah, definitely. Because I think the annuity industry has come a long way. It was definitely an uphill battle just because of such the bad reputation annuities got when they were introduced and really heavily pushed in the 20 years ago, or 30 years ago, even at this point. And they've made a lot of progress. And I feel people are finally starting to understand that, annuities aren't just this evil, product. There is a use for annuities. There is a lot of good that can come from annuities. You just have to make sure it's the right fit. And I think the CFP board is hoping that, that progress doesn't get backpedaled just because of these one size fits all, 401k annuities.
Yeah, and for the exam, you and I are always talking about RTFQ,
Mhm.
read the full question, and I think that's how these questions will come down, where they'll describe some objectives, and maybe there is an objective to take as much money as they possibly can out of the qualified plan in a short period of time, something like that. Well, the annuity really wouldn't serve that purpose, to have it up there and then liquidate it all in one lump sum. I just, you be careful with that kind of narrative.
Definitely, definitely. Well, awesome. You ready for the next slide, Mike?
Yeah, let's see what the next card has.
Let's dive in. Here it is.
There it
Required
is.
required minimum distribution age increased from 70 and a half to 72. This I just feel is just a ease of life change. Like calculating that half year at the 70 and a half gave so many students fits. For whatever reason, especially like if they were born halfway through the year and then did they change 70 and a half? No or yes. And it gets pushed back to the next year plus deferring it a year. Like it just caused so much confusion for clients, and it also can cause a lot of confusion for financial advisors. And now I feel they've just simplified it to make all our lives easier.
Yes, exactly. I mean, the fact that there's a year and a half more they can wait, I don't think that's a very big deal. But it's easier to look at and plan with. Um, and then I like this fact too for those 70-year-olds out there that say this year would be required for RMD, who have taken some big hits in the market. um, where your balance is based on the December 31st of the previous year.
True.
So
Yeah.
you're liquidating things to take the RMD at the worst possible time. Well, this gives some breathing space, perhaps for some markets to recover before the RMDs would need to start.
Right. Yeah. Like you said, adding a year and a half doesn't really change much, especially just because, life expectancy goes up over time. So just adding a bit more time at the end is just natural. But yeah, as far as like changing questions, I feel all the questions are going to still be the same. The only difference is it's going to be a little bit easier to calculate since you're not going to have to muck around with half years.
Exactly. But understand that if somebody had turned 70 and a half last year and were already required to take distribution, they're not going to be able to now stop and wait until 72.
Right. If you deferred your 2019 RMD because it was your first RMD and you get to, defer it that extra year until April 1st of the following year, you still have to take it. You don't get grandfathered in. They're very clear, it's only applicable to people born after July 1st, 1949.
Right. Yeah. but I think this is good. I think recent times in our economy, and even moving forward now for a while, some folks might decide to work a little bit longer.
Yeah.
So why not be forced? Why not take advantage of not having to take income that maybe you don't need right now by pushing it out to 72?
Right. Definitely. I feel that's kind of pretty much all we have to say about this slide. There, I mean, while it's an important change, it's pretty much just do it the same way you did before. Just we're making it a little easier for you.
Yeah, yeah, I agree.
Awesome. Let's dive into the next one. Disclosure regarding lifetime income. Tell me about this one, Mike.
Yeah, this one, I hope I interpret correctly, but I think it's linked back to the annuity business, is it not? Which
Hmm.
could provide a lifetime income option. And here they're saying you have to let your participants know that each year that they could do that. Is that how you read this?
That's how I read it too, but honestly, it's such a vague part of the legislation. You know, even the CFP board in red here is highlighting, you know, more legislative or administrative clarification is required before this will be tested on the CFP exam. So this probably isn't going to show up on any CFP exam soon, but it will eventually once we actually know what it means. And I feel even the CFP board is kind of playing the wait and see in that regard.
Yeah, because I look at that first piece that in the gold type, requires benefit statements provided to defined contribution plan participants to include a lifetime income disclosure. So I'm looking at that saying, well, this could be notifying them of the right to have some money in an annuity in this plan, or here are some projections that if X number of dollars were in the annuity, it could provide lifetime income of X, because a defined contribution plan doesn't make that promise, of course. So we'll see how it plays out, but that's my interpretation of those two pieces.
Yeah, exactly. You know, we're kind of playing wait and see. In a nutshell, it's basically make sure you tell your clients about, you know, all necessary disclosures, and make sure you're choosing the right, you know, retirement goals for them.
Sure, which is, advisors have been doing that forever. And so now we just have a little bit more to talk about.
Yep, exactly.
Yeah.
Moving right along, we have the expansion of the 529 education savings account, which I think this might be one of my favorite changes with the Secure Act. Really increases the flexibility of 529s and, you know, increases the power of which you can use them.
Yeah, this is pretty cool. Especially, what catches my attention now is the homeschooling.
Hmm.
Under self quarantine, everybody's homeschooling. So, if there was a 529 already in place, what kind of expenses could they offset that they've had to invest in to do the homeschooling that they wanted to? And then there's, of course, um, always been homeschoolers out there already that now could maybe benefit from these tax preferred dollars.
Yeah, it also definitely feels like 529 is becoming the preferred college savings method. You know, every year we get closer and closer to just having one unified savings plan. You know, the benefits of the 529s are really starting to outweigh the Coverdale and the UGMAs and UTMAs. Not to say that, you know, those other plans don't have their niche purposes where they can still be powerful, but it definitely feels like 529s are the preferred plan moving forward.
I agree, and that's a very important point that you're making. Again, uh, to be cautious, because originally, if a 529 was set up for college, and we start getting into it for all of these other things, what's going to be there for college? Or would we be better off just having a separate 529 for these pieces that they can now use it for that
Mm.
weren't there before? You want the money to be there for college too. So, maybe set up a couple of them.
Right. Yeah, that is a good point. But yeah, I'm waiting for the day, Mike, when they say, you know what, 529 plans don't necessarily need to be used for college. And that's the day when like the UGMA and UTMA accounts will probably, you know, stop being created. Because
Yeah.
I feel that's kind of the only, you know, if you got a question where it's like client is thinking about setting up an account, for their kid. The kid may or may not go to college. That is pretty much one of the only times I would, circle back to the UGMA for a college savings plan.
Exactly. Yeah, good point. But this was nice. I agree with you. This was a nice it was not so much related to retirement,
Mhm.
that the Secure Act is about, but it's a nice benefit.
Yeah. Also, we might actually see an uptick in 529 use for the second bullet point under considerations, where up to $10,000 per beneficiary per lifetime can be used for student loan repayments.
Hmm.
Depending on how much debt someone has, you could actually see people who have been out of school for years opening a 529 for themselves, in order to kind of take advantage of that. If they can get some outsized returns tax free in a 529, and then use that money to pay off a loan if it gets deferred, where interest isn't building up for one reason or another. That could be also an interesting tax strategy for individuals who are well outside of college.
Sure, and the flexibility in a 529 to change the beneficiary to
Yeah.
another
Oh,
person that's in the family. Maybe one didn't go on to college, but another one did and has sizable loans. We
yeah.
could change the beneficiary and then use this feature to help out with the loans.
Yeah, even that's probably the more likely situation to happen. Older sibling finishes college and graduates with some loan debt. Younger sibling decides they don't want to go to college, so mom and dad transfer it to the older sibling and pay off $10,000 of that debt.
Yeah, exactly. I wish it were higher
Mhm.
than 10,000, but that seems to be where the IRS likes to start these kind of things.
Yeah, they love their $10,000 exception. ten
Yeah.
thousand dollars for the first time home purchase.
Yes, yes, yes.
But it's a nice round number, so the
That's
IRS is
right.
all aboard.
Yeah, but then when you look with somebody with $200,000-300,000 of school debt, it's not going to be real exciting. But anyway, it's
Oh
it's
yeah.
it's
Well, like
there.
I'm looking at houses around the Boston area now myself, and $10,000 won't even be a 5% down payment.
Yeah, yeah. Well, I
But
have a a doctor in my family who is in fifth year of residency, but the total loans right now are at 350 to $400,000.
yeah, so that $10,000 is nice, but it's a fairly small dent in that
Yeah.
that mountain. Awesome. Well, let's move on. Getting close to the end here. Modified required minimum distribution rules.
Yeah, this is kind of the heavy in there. That maybe is the one bummer, huh?
Yeah, it's well, for two reasons. One, because it's kind of a disadvantage now with the loss of the stretch IRAs.
Right.
And also just for a study perspective, it's some fairly dense rules that are probably going to be one of the harder areas for people to master for the test.
Exactly. Yep. And that learning objective, impact this provision will have on beneficiary IRA planning. And the stretch, you said it, the stretch is really what this was intended to end. But that's the way so many people have structured the IRAs.
Yeah.
And for those of you that haven't worked with that before, you would name a beneficiary, say a spouse, and then the next beneficiary, the spouse names the beneficiary of one of the children, and then their child and so forth. So you stretch out these RMDs over generations, and
Mhm.
they've put the kibosh on that.
Yeah, basically the way it used to work was when you inherited an IRA, the RMD schedule would be based on the life expectancy of the person who inherited it. So, if you inherited your grandparents' IRA and you're 20, your RMD payment distributions are going to be pretty much negligible just because of how long your life expectancy is at age 20.
Mm-hmm. Good point. Mm-hmm.
So now they've changed it. So now instead of this kind of infinite stretch IRA scenario that people were doing, they're now putting a 10-year maximum cap on it, where the IRA has to be fully distributed after 10 years.
Yeah, that's harsh for a big balance.
Yeah,
It,
if you get like a $2 million IRA that you inherit, 10 years, $2 million, like that's going to push you into some of the highest tax brackets if you don't do it all at once. And even if you do it all at once, you're going to definitely be in the highest tax bracket.
yeah, yeah. So this one we have to be careful, but as advisors, uh, we need to be meeting with clients about this, and see, does this impact, maybe there's a child that is not age of majority yet that's a beneficiary, but will age out of one of these exceptions. If you look under consideration, um, the general rule here is it's going to need to be drained within 10 years, that inherited account. But there are some exceptions for surviving spouses, eligible minor children, people with disabilities or chronic illness, and people less than 10 years younger than the decedent.
Anytime Congress comes out with one of these bills, there's always a period of vagueness where there's parts of it that people aren't 100% sure on, and it comes down to either more guidance from the IRS or more guidance from Congress, or court cases that get brought up. There are still gray areas of the Tax Cuts and Jobs Act that are getting figured out, and we're almost 2 years away from that going into place.
Yeah.
And there's still vague gray areas that are getting figured out in the court system. So these are almost living documents. They change over time, and it really is going to take time for it to sink in and for people to kind of work out the kinks. Well, awesome, Mike. Not too much there when you kind of put it all together like that. The Secure Act bill is, I don't know how many 100 pages. It's a monster to get through, but luckily the CFP board here put it all together in 6 short slides that highlight the key points. This I think is a really key just study guide for people that they want to be really comfortable with as they're studying for the July and future exams.
Yeah, I agree. Focus on what's in here for the exam. In practice, if you work with companies that have 401ks, or maybe you're thinking about putting one in, there is some good legislation that's part of the Secure Act to benefit businesses, particularly smaller businesses, to have a qualified plan or to allow part-time people to be in. So read those sections of the act as well, if that applies to you in real life.
Yeah, definitely. I mean, just because the CFP board didn't feel parts of it were relevant to the exam itself, that doesn't necessarily mean they're not relevant to you or your clients.
Mm-hmm.
So yeah, it definitely does pay to be familiar with all of the parts of the document, but this is a good starting line to get ready for the actual exams, and then from there you can build your knowledge out by looking at different resources.
Absolutely.
Awesome. Well, great times chatting with you, Mike. I hope our students get a lot out of this. And, as always, if people have questions, they can feel free to write in or give us a call. Happy to chat about this. And, we'll have some more details and information on other parts that have been changing coming out in the future.
Yeah, stay tuned. We're always adding something in the library.
Yeah.
Thanks, Jerry, for setting this up.
Anytime, Mike, anytime. And if you're looking to learn more about the CFP exam, make sure to check out biffbites.com. That's BIF bites.com. That's where we have all of our podcasts and videos and practice questions and, all the great stuff we're coming out with to help you guys get ready for the CFP exam.